Welcome to the deep dive. Today, we are taking a scalpel to, well, one of the hottest tech names out there, Figma. We're talking jaw-dropping financials here, but also a valuation that's been on a real roller coaster since their IPO. So, our mission today, unpack the whole investment case for you. We'll dissect that competitive moat they built, look hard at the frankly spectacular financials, and then face the big valuation risks. And just to set the scene, remember that dramatic backstory. Figma walking away from a $20 billion Adobe deal late 2023. Regulators grilled it, and Figma pocketed a cool $1 billion reverse termination fee for their trouble. Independence plus cash.
Yeah, that $1 billion really tells a story, doesn't it? It screams confidence, both from them and, what the market perceived their standalone value to be, maybe even more than Adobe offered. But you're spot on. That confidence, that breakup to you, puts immense pressure on the public valuation now. So the question for us, the core question is, does Figma's performance, its lead in design, especially with AI coming on strong, does it really justify the price tag? Let's look to the evidence.
Okay, let's dig in. Foundation first. What is Figma's, core advantage? How did they grab over 40% of the design software market by early 2025? It started with disruption, right?
Exactly, disruption. And it wasn't just being web-based, though that was huge, moving off desktops like Sketch. The real game changer was the real-time collaboration. Think Google Docs, but for complex design work. Suddenly essential for, well, every remote or hybrid team out there.
Okay, but lots of things are collaborative now. What's the hard part to copy? The technical moat.
Yeah, the moat. It's deep. Under the hood, they built this complex rendering engine in C++ thing. Okay, then compiled it to WebAssembly or WARSAM. That gives you almost native app speed right in your browser. But that's just like part one. Part two is the real magic for collaboration. Custom tech, things called operational transforms, OT, and conflict-free replicated data types, CRDTs.
Whoa, okay, CRDTs. Let's pause there. Why is that such a big deal? Why is that hard for, say, Adobe to just replicate?
Because it solves a fundamental physics problem of the internet, essentially. How do you let 50 people anywhere in the world edit the exact same thing at the exact same millisecond without it breaking or lagging horribly? Standard approaches struggle. If two people click save, whose version wins? It creates conflicts, delays. CRDTs are these, well, elegant algorithms that ensure consistency. No matter when the edits arrive, the final result is always correct and it feels instantaneous. Building that takes years of specialized engineering. It's not something you just bolt on.
Got it. So that complex, hard-to-copy tech foundation, that directly enables the efficiency we're about to see in the financials. And it's worth remembering, they were already on a tear while that Adobe deal was stuck in limbo, September 22 to late 23. Sources show they were hiring like crazy, then workforce up from 800 to 1,300. And expecting, 40% revenue growth that year, they weren't waiting around.
Not at all. They had momentum, a juggernaut already taking market share.
Which brings us neatly to the numbers. Right. This is where it gets really compelling. Moving from product strength to financial dominance. Let's hit those metrics. FY24, Q1 2025, they are pretty extraordinary.
You really are. Okay, so FY24 GAAP revenue, $749 million. And that was 48% growth year over year. Huge number. That pace basically continued. Q1 2025, their annual recurring revenue, ARR, hit $912 million. Still growing at 46% year over year.
Incredible growth. But what about efficiency? That's key for SaaS.
Oh, the efficiencies is maybe even more impressive. Gross margins, consistently between 88% and 91%.
Wow.
Yeah, they keep almost 90 cents of every dollar after the direct costs of delivering the service. That's that scalable cloud-native architecture we just talked about paying off. Very lean operation for the scale.
And the famous rule of 40, the SaaS benchmark, how do they stack up?
They crushed it. So quick refresher, rule of 40, you add revenue growth rate and profit margin. If it's over 40, that's considered excellent, right?
Yeah.
Balancing growth and profit. Figma hit 63 in Q1 2025.
63.
Yep. 46% growth plus a 17% operating margin. That puts them in really elite SaaS territory. Shows incredible financial discipline even while scaling that fast.
Okay, and they're landing the big fish too. Enterprise traction.
Absolutely. 95% of the Fortune 500 are using Figma in some capacity now. And they have, get this, over 1,000 enterprise customers paying more than $100,000 a year.
That leads to the stickiness a metric investors love.
Exactly. Net dollar retention, or NDR. How much more existing customers spend year after year? For Figma's bigger customers, the ones spending over $10, NDR is 132%.
132%.
132. Meaning the average large customer increases their spending with Figma by 32% each year.
How does that compare? Put that in context for.
It's stellar. Adobe's NDR, their big competitor, is around 110%. Even a really strong SaaS company like Atlassian is maybe 120%. So 132%. That ability to expand within accounts, that's arguably their crown jewel financially.
So, okay, let's connect the dots. If the fundamentals are this good, 132% NDR, 91% gross margins, rule of 40 at 63, why the huge stock drop after the IPO? What gives? Is it purely the initial valuation was just way too high, or is the market seeing something else? A risk?
Well, it's definitely a bit of both. Valuation expectations certainly hit the wall of reality. But the market is also looking ahead, asking how they sustain this incredible growth. And a big part of that answer, and that 132% NDR, is their platform strategy. They're not just a design tool anymore.
Right. The product operating system ideal.
Exactly. They've expanded. You've got FigJam for whiteboarding, Dev Mode for engineers, Slides, Sites, Buzz, Draw, even this new AI tool, Make. And it's working. 76% of their customers now use 2 or more of these products. That was only 64% a year ago. So they're bundling, increasing stickiness, raising that contract value.
And AI is central to that future platform, right?
Yeah.
Not just a bolt-on feature.
Absolutely critical. Figma Make 2.0, their AI tool, is pretty ambitious. It's not just generating pictures. It's supposed to generate functional prototypes from just talking to it, from prompts. They claim it can cut development time by like 40%. And apparently 51% of users are already building these agentic AI agents on the platform.
40% reduction. That's huge.
It is. And it feeds into that bigger question we should maybe touch on later. If AI speeds everything up that much, does the lifespan of any dominant platform get shorter? Faster disruption cycles?
Interesting point. A potential risk layer on top of everything else. Let's park that for a moment. Back to today's revenue. This platform expansion, it's fueled by a pricing strategy people call, well, genius, but maybe also controversial, this role-based pricing.
Yeah, it's clever from a business perspective. They move beyond just charging designers. Now, there are paid seats specifically for others involved in the process, a dev seat for engineers using Dev Mode and Code Connect, a content seat maybe for marketers writing copy, even a cheaper collab seat for people who just review.
Yeah.
And the result? More revenue from the whole team. Developers, for instance, are now 30% of their monthly active users. They've successfully monetized users who used to just, peek in for free.
Okay, monetization engine firing.
But friction. We're hearing complaints, right? Users calling the pricing opaque, even predatory.
Yeah.
Like forcing a client to buy a seat, even if their freelancer already has a paid seat. That raises this specter of enshittification. Can you unpack that term a bit? Yeah, it's a blunt term, but it captures a real concern. It describes that pattern where platforms, once they dominate, start squeezing users more. Maybe the experience gets worse, pricing gets complex or feels unfair because users feel locked in. Because Figma is so dominant now, some users feel trapped, subject to price hikes or these licensing rules that feel, well, extractive. It's a major risk for any company relying on user love and loyalty.
And that tension, that's got to be part of the valuation puzzle, right? Which brings us to the public market debut.
Definitely part of it. Okay, the IPO, July 2025, it was wild. Priced at $33 a share.
But didn't it just skyrocket on day one?
Oh, yeah. A shot up to $122. That gave it this initial valuation of like $55 billion, just massive hype.
Reality check.
Swift and sharp. After their first earnings report as a public company, Q2 2025, the stock tanked, dropped nearly 20% in a single day. By early September 2025, it had fallen about 55% from that peak. Market cap settled around $26.6 billion. Still huge, but a major haircut.
Okay, so even after falling 55%, where does that leave the valuation multiples? Still seem high.
Extremely high, yeah. Even at $26 billion, you're looking at roughly a 22x trailing price-to-sales ratio.
22 times sales.
And based on their Q2 adjusted profit, the adjusted price-to-earnings ratio was around 170.
PE of 170, okay.
Yeah, those are multiples that price in perfection for years to come. There's just no room for error, no room for slowing growth at that price.
And the competition isn't standing still either. It's not just Adobe.
Not at all. You've got the giants, Adobe, Microsoft, maybe even Apple, circling parts of the creative space, but also really strong focused players. Canva is huge in broader visual communication. Miro is a leader in whiteboarding. Webflow in no-code, low-code websites. By becoming this product OS, Figma is now fighting on multiple fronts against specialized leaders. That takes resources focus.
Then there's the execution risk analysts talk about. CEO Dylan Field, obviously a visionary, started the company at 19, but leading a $26 billion public company, that's different.
Right. The risk isn't really about his age per se. It's about scaling leadership. Can the team that grew so fast, that navigated the Adobe deal saga, maintain that high-growth execution and deal with Wall Street scrutiny, public market pressures, regulatory spotlights? It's a different ballgame.
And we have to mention the user friction again, the pricing complaints. If that starts to erode the user base or slow down that NDR.
That 132% NDR could definitely soften if users feel squeezed too hard. It's a balancing act.
Plus the optics of the CEO, Dylan Field, planning to sell, what, $60 million in shares post-IPO? That always makes investors a bit nervous.
It adds to the narrative, sure. So you boil it all down, and the analyst consensus kind of reflects this whole picture. They see Figma as a high-conviction, long-term bet if you believe in AI-driven SaaS and Figma's leadership there.
Got it.
The valuation leaves zero wiggle room. As one NASDAQ analyst apparently put it after the IPO drop, the stock still needed more cooling down. It needs to find a level that balances the amazing business with the very real risks and the high price.
It really is an incredible contrast, isn't it? Flawless-looking fundamentals, 91% margins, 132% NDR slammed up against these sky-high multiples in this growing list of risks, competition, execution questions.
Absolutely, and maybe that brings us back to that AI point we parked earlier. Figma make promises 40% faster development. If AI generally accelerates design and prototyping that much, does the whole competitive clock speed up? Does the time a platform like Figma can stay dominant get shorter before the next AI-native disruptor comes along? Should investors start factoring in shorter market dominance cycles because of AI? That's the big, maybe unsettling question hanging over not just Figma, but the whole tech landscape right now.
A really crucial thought to chew on for anyone investing in tech today. Thank you for walking us through all that complexity. We hope this deep dive leaves you feeling much better informed to weigh up those very significant risks and potential rewards with Figma. Thanks for joining us.